decades, we have cut the rate by about 500 basis points when the economy is in recession. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continue to address that risk. While the framework must evolve, some elements of it are timeless. Policymakers emerged from the Great Inflation with a clear understanding that it was essential to anchor inflation expectations at an appropriately low level. During the Great Moderation, well-anchored inflation expectations allowed us to provide policy support to employment without risking destabilizing inflation. Since the Great Inflation, the U.S. economy has had 3 of its 4 longest expansions on record. Reflecting what we have learned about the economy and the way those changes were interpreted by the public. In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting. We will ensure that our new consensus statement is robust to a wide range of economic environments and developments. In addition to revising the consensus statement, we will also consider potential enhancements to our formal policy communications, particularly regarding the role of forecasts and uncertainty. As we have been reviewing assessments of the 2020 framework and of policy decisions in recent years, a common observation is the need for clear communications as complex events unfold. While academics and market participants generally have viewed the FOMC communications as effective, there is always room for improvement. Indeed, clear communication is an issue even in relatively placid times. A critical question is how to foster a broader understanding of the uncertainty that the economy generally faces. In periods with larger, more frequent, or more disparate shocks, effective communication requires that we convey the uncertainty that surrounds our understanding of the economy and the outlook. We will examine ways to improve along that dimension as we move forward. So let me end by saying thank you again for being here. We've been looking forward to this. All of us have been looking forward to being with you today and having these conversations that will occur over the next 2 days. These discussions will help broaden and deepen our thinking about these issues, and they're critical to the success of these reviews. Thank you very much.
Right, thank you very much.
Okay, so the speech
We are
is
going to
started.
just roll right into our first paper session today. On the agenda today will be sessions that address the 2 sides of the Federal Reserve's dual mandate, employment and inflation.
We are just on
and
time.
also
We're
the
just on
strategies and
time.
tools
We're
used
just
to pursue
on
those
time
goals.
for these.
So I'm
Let's
going to turn it
listen
over
to
to my
what Jerome
colleague,
Powell has
Stephanie
to
Aronson.
say.
I'm about to meet with Nomadic. What do I need to know?
Show me accounts visiting our website.
Which accounts are at risk of drafting emails?
Market is closed.
Carries the heavyweight, usually carries the heavyweight. So what do you mean programming is? You mean to say it's over?
Organizing this conference, a whole lot of work went into bringing us together. As in our last review, the 2025 review consists of 3 key elements: this conference, Fed Listens events at the reserve banks around the country, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In the current review, we will reconsider aspects of our strategic framework in light of the experience of the last 5 years. We will also consider possible enhancements to the committee's policy communication tools regarding forecasts, uncertainty, and risks. In 2012, the FOMC first codified our monetary policy framework in a document entitled the Statement on Longer-Run Goals and Monetary Policy Strategy, which we refer to as the Consensus Statement. The language in the opening paragraph, which has never changed, articulates our commitment to fulfilling our congressional mandate and to explaining clearly what we're doing and why. That clarity reduces uncertainty, improves the effectiveness of our policy, and enhances transparency and accountability. As chair, Ben Bernanke led the committee through the creation of that initial consensus statement, adopting a 2% inflation target and outlining our approach to achieving our congressionally assigned dual mandate. The framework laid out in that document broadly aligned with best practices for a flexible inflation targeting central bank. The structure of the economy evolves over time, and monetary policymakers' strategies, tools, and communications need to evolve with it. The challenges presented by the Great Depression differ from those of the Great Inflation and the Great Moderation, which in turn differ from the ones we face today. A framework should be robust to a broad range of conditions, but also needs to be updated periodically as the economy and our understanding of it evolve. From 2012 to 2018, the FOMC voted at each January meeting to reaffirm the consensus statement, in most years without substantive changes. In 2019, we changed that practice, conducting our first ever public review, and said that we would repeat such reviews at roughly a 5-year interval. There's nothing magic about a 5-year pace. We believe that frequency is appropriate to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. Several of our global peers have adopted similar approaches to their framework reviews. At the time of the last review, we had been living for about a decade in a new normal characterized by proximity to the effective lower bound, with low interest rates, low growth, low inflation, and a very flat Phillips curve. If I could capture that era with one statistic, it would be that the policy rate had been stuck at the lower bound for 7 long years following the onset of the global financial crisis in late 2008. After liftoff in December 2015, we were able to raise the policy rate only very gradually over a period of 3 years to a peak of just 2.4%. 7 months later, we began reducing it, leaving the rate at 1.6% in late 2019, where it would be when the pandemic arrived a few months later. Policy rates in other major advanced economies were even lower, in many cases below zero, and in all such.
So he's just defending why they hold the interest rates steady. The most important thing I want to hear from him is what is going to happen next.
We would be right back at the lower bound, probably for another extended period. The post-financial crisis decade had demonstrated the pain that that could bring. Inflation would likely decline in a weak economy, raising real interest rates as nominal rates are pinned at zero. Higher real rates would further weigh on job growth and reinforce downward pressure on inflation and inflation expectations. Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target, an approach that was common in the extensive literature on the risks associated with the lower bound. Given the downside risks to employment and inflation from proximity to the lower bound, and the need to anchor longer-term inflation expectations at 2%, we said that following periods in which inflation has been running persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time. We also concluded that policy decisions would be informed by assessments of shortfalls rather than deviations from maximum employment. The change to shortfalls was not a commitment to permanently forswear preemption or to ignore labor market tightness. Rather, it signaled that apparent labor market tightness would not, in isolation, be enough to trigger a policy response, unless the committee believed that, if left unchecked, it would lead to unwelcome inflationary pressure. This change reflected our experience with long expansions that featured historically low unemployment amid low and stable inflation, suggesting.
So job markets have come up positive of late, and he's defending also why they need to have their steady interest rates. Very interesting to note. Very interesting to note.
That a policy approach that carefully probed for the maximum level of employment could bring about the benefits of a strong labor market without risking price stability. In the years just prior to the pandemic, for example, unemployment was at multi-decade lows while inflation ran below 2%. By December 2019, estimates of the longer-run unemployment rate had fallen sharply. The use of shortfalls acknowledged that a combination of low inflation and low unemployment does not necessarily pose an adverse trade-off for monetary policy. The economic conditions that brought us close to the lower bound and drove the changes in our consensus statement were thought to be rooted in slow-moving global factors that were likely to persist for an extended period, at least until our next 5-year review. And that might well have been the case had the pandemic not intervened. The idea of an intentional moderate overshoot proved irrelevant to our policy discussions and has remained so through today. There was nothing intentional or moderate about the global inflation that arrived a few months after we announced our changes to the consensus statement, and I acknowledged as much publicly in December 2021. We fell back on the rest of the framework, which called for traditional inflation targeting. Through the end of 2021, FOMC participants continued to forecast that inflation was likely to subside fairly quickly in 2022, with only a moderate increase in our policy rate. That projection was consistent with other central banks with different frameworks and the vast majority of forecasters. When the evidence showed otherwise, we hiked 525 basis points over a period of 16 months. The most recent data suggests that 12-month PCE inflation was 2.2% in April, far below its 7.2% peak in 2022. And in a welcome and historically unusual result, as this room knows, this disinflation has come without the sharp increase in unemployment that has often accompanied a campaign of rate hikes to reduce inflation. The economic environment has changed significantly since.
Truth be told, they've come from a long, long way. It's been a long way since inflation was at 9%, 7%.
2020, and our review will reflect our assessment of those changes. Longer-term interest rates are a good deal higher now, driven largely by real rates given the stability of longer-term inflation expectations. Many estimates of the longer-run level of the policy rate have risen, including those in the Summary of Economic Projections. Higher real rates may also reflect the possibility that inflation could be more volatile going forward than during the inter-crisis period of the 2010s. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. While our policy rate is currently well above the lower bound, in recent decades, we have cut the rate by about 500 basis points when the economy is in recession. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continue to address that risk. While the framework must evolve, some elements of it are timeless. Policymakers emerged from the Great Inflation with a clear understanding that it was essential to anchor inflation expectations at an appropriately low level. During the Great Moderation, well-anchored inflation expectations allowed us to provide policy support to employment without risking destabilizing inflation. Since the Great Inflation, the U.S. economy has had 3 of its 4 longest expansions on record. Anchored expectations played a key role in facilitating these expansions. More recently, without that anchor, it would not have been possible to achieve a roughly 5 percentage point disinflation without a spike in unemployment. Keeping longer-run inflation expectations anchored was a driving force behind establishing the 2% target in the 2012 framework. Maintaining that anchor was a major consideration behind the changes in 2020. Anchored expectations are critical to everything we do, and we remain fully committed to the 2% target today. In the current review, the committee is engaged in discussions about what we have learned from the experience of the past 5 years. We plan to complete consideration of specific changes to the consensus statement in coming months. We're paying particular attention to the 2020 changes as we consider discrete but important updates reflecting what we have learned about the economy and the way those changes were interpreted by the public. In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting. We will ensure that our new consensus statement is robust to a wide range of economic environments and developments. In addition to revising the consensus statement, we will also consider potential enhancements to our formal policy communications, particularly regarding the role of forecasts and uncertainty. As we have been reviewing assessments of the 2020 framework and of policy decisions in recent years, a common observation is the need for clear communications as complex events unfold. While academics and market participants generally have viewed the FOMC communications as effective, there is always room for improvement. Indeed, clear communication is an issue even in relatively placid times. A critical question is how to foster a broader understanding of the uncertainty that the economy generally faces.
Yeah, that's something that they've been battling, especially with the current president, Trump, calling him a brick wall. There were some heavy words that were shared last week. Trump should have listened. Jerome should have listened. Everyone doesn't want to let their ego down. And that affects communication because as investors, are people who are really interested into the financial markets, we want to know what is the way forward. Are these people speaking the same language? And that is really helpful to know in an economy. Because when you have the government speaking a different tone, the Fed Reserve speaking a different tone, they are in the same country, but they're independent of each other. And there has to be cohesion into how they talk about things, because what they're talking about is the livelihood of so many people. It needs to be improved. I second that, Jerome. I concur with that.
In periods with larger, more frequent, or more disparate shocks, effective communication requires that we convey the uncertainty that surrounds our understanding of the economy and the outlook. We will examine ways to improve along that dimension as we move forward. So let me end by saying thank you again for being here. We've been looking forward to this. All of us have been looking forward to being with you today and having these conversations that will occur over the next 2 days. These discussions will help broaden and deepen our thinking about these issues, and they're critical to the success of these reviews. Thank you very much.
All right, thank you very much.
Interesting stuff. So back to the charts, huh? Back to the charts. Let's look for an opportunity before New York, like right now. I want to catch at least 100 pips. Like 100 is going to be decent for me. Looking at price action, and this is something I've been noting. So when I woke up today, prices was here. There was no clear indication of buying this market. Like literally, there was no clear sign that the markets would reverse the way it did. For some people, maybe they called it. For me personally, my strategy didn't align with what I'm looking at. But currently, where we are, I really like what's happening. I really like how prices is aggravating towards the daily highs. I want to mark out this zone. So PPI, just to bring everyone on board here, I'm going to mark this order block. I'm going to mark that order block. If I can take you back to the news releases, so PPI came out negative, quite negative. Looking at it, quite negative, really quite negative. The last time we had such a number was back in 2020. Whoa. Very interesting things to note. But employment is good. Employment is good. And that is what Jerome is really holding on to. Because he has mentioned severally that if we are heading towards a recession, then we will see an uptick in the number of people who are losing jobs. Unemployment claims has actually come out. How is this possible? At 229,000, same as last week, but this is the revised number, so it's good. It's good. I would want to see the revision, but this is quite interesting. For 2 weeks straight, we have seen literally the same number of people claiming unemployment at 229,000, which is good. Which is good. If you look at it, we've come a long way, and that's what Jerome Powell is really appreciating currently at the moment. We have come literally a long way. We are not in red territories. I do believe gold, this is just my opinion, gold is overbought. The economy of the United States is going to pick up very soon. Really soon. Last Friday, 2.2 trillion was added to the markets. That's quite significant. During the flash crash that we had quite some time back, if I can pull up that chart, it was somewhere around this region. Yeah, where was it? This is the 30-minute time frame. Let me go to the H4 time frame. During this period here, I do believe it was around this region. Yeah, around this region, we had quite the amount. So this move was equivalent to nearly 4 trillion. I do believe it was this move. Yeah, it was this move when gold went and made an all-time high. So this was 4 trillion being wiped out in the financial markets within this period. Right now, we've had at least 2 trillion being added to the markets. Now, whenever prices of gold goes down, it means the United States dollar is doing good. Now, the thing which makes me look for buying opportunities in gold is that looking at price action, we are clearly breaking structure to the downside. This is an obvious trend whereby these lows closed below these lows with this specific candlestick. Okay, this was yesterday. Was it yesterday? Last week. This was last week. And looking at how price action has been playing out, sorry, this was yesterday. Look at how this particular candlestick closed below this range. Okay, very interesting stuff to note. We can clearly see the prices are heading to the downside. What do I mean by this? We are clearly having lower lows, lower highs, lower lows, lower highs. Look at this price action. We can consider this a lower high. Then finally, we are in this position where we are currently at the moment. Now, looking at it, prices is coming back to fill inefficiencies because ever since the week did begin, if you look at it on where's Monday, darling? So this is Monday. Look at how Monday opened. Ever since Monday opened, we rallied to the downside. And this is something that, okay, if there's 2 trillion being added to the markets, you anticipate such a thing happening in the financial markets. Very, very common. The investors in the United States are currently favoring the United States dollar over other assets. When you look at gold, gold thrives during times of uncertainties. Could the fear be behind us already? That's the thing that I want to question the most. Could the storm be behind us? For investors, trading gold on a consistent basis when the markets are calm and collected doesn't make sense. And this is the reason. No? I want you to follow me on this. This is gold. On gold, we have seen ever since this high. If we can take this high to this low. So over the past 23 days, we have seen gold lose 10% of its total value in the past 23 days. You can say almost one trading month. Quite significant, if you can ask me. And the question begs, is there more to come? Could what is happening right now be a short-term retracement for a further continuation to the downside? It's all about a probabilities game. And you have to have a plan. Plan your trades, trade your plan. Look at this price action. I really like what I'm saying currently at the moment, especially this part here. This high failed to break the all-time high that we did form on gold. This low broke the most recent low. 2 lows to be exact. This is what I want to say. I do believe in the next few trading weeks, 29, gold will go back down to $3,000 an ounce. In the next few trading weeks, gold will go down to $3,000 an ounce. That's almost 2,000 pips, more or less, from where we are currently at the moment. You can really make a good living on 2,000 pips. If you execute a 0.01, that's $200. A 0.1, that's $2,000. And 1.0, that's $20,000. And I'm willing to take that opportunity. I'm willing to short this market to those lows. I will look for entry positions because this is my reason. Huh? I'm going to execute on gold, but look at dollar index. So this is the dollar index on the daily time frame. So this is a measure of how the United States dollar is performing. We did break these lows, but prices are above. If we do close above this region, if we do close this week, if today's trading, if this current trading week closes above this low, let me highlight it. This is sentiment analysis compared to technical fundamentals, everything. If we do close above this region, I'll be very confident in looking for buying opportunities on gold or on US dollar, sorry, because a stronger DXY shows that the United States is going to be stronger. We do have a change in state of delivery already, whereby look at how these candlesticks are printing at the moment, whereby we do have higher highs, higher lows, higher highs, higher lows. We did break this current structure over here with a clear, this particular clear candlestick. We had an order block here. Prices rallied to the upper side, came back down to fulfill that OB. Could this be an opportunity for the dollar index to continue rallying further to the upper side? This is what I'll be talking about. I'm not going to trade dollar index, but this is something that is going to help me with sentiment. Now, looking at it, how long, if someone could be asking, how long will it take for you to be in this particular execution? Looking at it from this high, let's pick this high to this low, almost 10%, the same thing we've seen on gold, but this one took 99 days. I do anticipate in the next less than 100 trading days that we are going to see a regaining of the dollar, whereby it's going to gain back what it's been losing ever since. Now, when you look at it from a point of, this is speaking purely out of historical data. Let me have my face clear. Looking at it at historical data, when Trump came into office, he started signing off a few things. People perceived it negatively, but I do believe he has good advisors. I do believe he has good advisors. And whenever something is being enacted for the first time, there's usually fear. It's human nature, whereby most of the times, and this is what has enabled us to evolve to where we are currently at the moment. It's fear that runs the markets, fear and greed, basically. Whenever people are fearful, they sell things. Whenever people are greedy, they'll start buying things. Very simple. Let that stick to you. Never let that out. Whenever people are fearful, they usually sell what they have. Whenever people are greedy, they usually buy. That's looking at the dollar. But when you look at other assets like safe havens, it's usually the vice versa. Whenever people are fearful, they usually buy safer havens. They usually sell risk of assets, and then they buy safe havens, and vice versa. Now, looking at it where we are currently at the moment, price action speaking. Look at this price. I like this price action so much. It's not the same compared to what we've been seeing in the past, whereby buyers are struggling to gain control, and slowly they are gaining control. Whereby, look at the times bears have tried to push this market down, rallies to the upside. They try to push it down, rallies even further to the upside. Right now, we are in this period here. Yes, data today for the PPI came out negative. It's okay. I believe that is going to engineer the liquidity that we need. Looking at the volatility index, we are below 18.6%. Quite good. This is normal trading, meaning we are going back to normal trading scenarios. US 500. Look at that uptick. Very interesting uptick that we have been seeing currently in the financial markets. Sorry about that. Going back to S&P 500. And let me confirm if we are audible. Okay, we're good to go. Look at the uptick. Look at how the S&P 500 has regained what it lost. Look at this. This is very amazing. We are almost back to all-time highs, technically speaking. Almost at all-time highs. And this is the result of people buying the fear. Stocks were much better priced on. I want to start investing in assets like I was looking at Nvidia. Oh, Nvidia is really up for the week. Nvidia is up 4 points something percent for the day. Look at the DAX 14. Tesla is really up. Oh my lord. Tesla is up how many percent ever since we had this dip? So in less than 35 days, we have seen almost 52% gain. Damn it. That's quite something, huh? That's quite something. Nikkei, same thing. I was looking at this opportunity. This was something that, and I'm not going to let these opportunities pass me again. I'm not going to allow such a thing to ever happen in my life again. Look at this. This was the perfect opportunity to buy Nikkei. Looking at other assets, look at Bitcoin. So Bitcoin is down for the day currently. It's okay. It's taking a breather. But looking at it on the 4-hour time frame, we are in this period of consolidation, very normal. Whenever prices make such a move, it usually relaxes. It's usually an impulse and then a correction, an impulse, then corrections, impulse, then corrections. It never shoots like an arrow. This is something I would also want to keep note of. I want to look at 110K all-time highs. Yeah, I want to see all-time highs very soon. So could this be an opportunity to buy? Let's look at it. Could this be an opportunity to buy Bitcoin? Let's go to the 1-hour time frame today. So we have no clear rate of liquidity. We have not traded liquidity. Having pending orders below this region could be interesting. Now, looking at gold, the correlation between gold and Bitcoin. Look at this. So on gold, we have already retraced. On Bitcoin, we are still on that journey. Now, this is purely sentiment. This is not technical analysis or partially technical analysis because we are looking at charts, but look at the correlation between these. We have already recovered what we did during Asian session on gold. On Bitcoin, we haven't. Even though as Bitcoin, the consolidation has been nearly 100,000, nearly the 100,000 price point. But on gold, it's quite massive in terms of the retracement that you did see. And this is something that I want to I'm looking at selling opportunities on gold because what I'm looking at currently at the moment is a stronger dollar in general over the past few trading weeks that are supposed to come. This could be a good opportunity. Let me switch over the brokers. Let me go to the H4 time frame. So you have to be very careful if you look at it. If you look at this H4 candlestick and this H4 chart, they are totally two different things. So sometimes you have to be very careful with what you're looking at. So this 4 candlestick is about to close in the next 38 minutes. It's because of the closing time. This one has an hour 30. Okay, so this one has just started. So we are going to stick with this one. I'm going to stick with this one because this one has just started. Now, if the next 38 minutes, this is the plan. This is the plan for gold. This is the plan. If the next 38 minutes, this candlestick closes below this region, the next 1 hour candlestick opens, forms a wick to the upper side, I'm shorting gold. Okay. So let's go down to the 1 hour time frame. So rules for entry, let me write it here. Let's increase the font. If the 1 hour closes below the zone, the next 1 hour opens with a wick. Within the first 5 minutes, it has to be within the first 5 minutes. Okay, so this is going to be a plan now. Let me take a screenshot. Now this one has to be very careful because we have already hit our weekly lows. Prices has not yet retraced to where it began during the weekly highs, and that's very interesting. So I want to be very cautious with this particular execution. I'm going to execute only if this happens. So if this happens, I'm going to sell the market. Technically, what I'm looking at is, so this candlestick closing below this structure, the next 1 hour opens, forms a wick to the upper side, then closes. Technically, sort of what we saw here. Now, this was a very interesting scenario that I was looking at, whereby I was looking at the same thing happening, but prices didn't come to my entry point. It missed my entry in less than 100 pips. It was less than 100 pips. Yeah, nearly 60 to 80 pips, somewhere around that region. And prices did leave me. So with this particular execution, I'm looking at 600 pips, but I'm not certain that we might hit another low before tomorrow closing. Today's Thursday. So today is Thursday, tomorrow is Friday. I'm not certain if we shall hit this take profit by tomorrow because the week has already progressed. If you look at it, prices has really made quite the interesting part. So this is what I want to say. This candlestick closing below this region, a retracement. So the next 1 hour candlestick opens with a wick to the upper side. I'll be looking for selling opportunities to the downside. So this is whereby patience becomes a virtue. So I usually like sticking to the 1 hour time frame. I like sticking to the 1 hour time frame. It's very hot here, man. Feeling sleepy. But yeah, I really like this scenario. I'm confident 600 pips, gold can do that. But if I do get a 300 pip, I can consider this successful trade. Like if you do hit 50% of these move from the highs to the lows, actually let me pull up a Fibonacci from this high to, from that low to this high, perfect, coinciding with these candlestick here. I don't believe if we go to a lower time frame, we'll find another block around this region. So I'll want to see inefficiencies, price points, whereby price will come back to those regions. And yes, we do have an OB. This is our order. Okay, perfecto. Interesting stuff. So I can see the struggle prices is making currently at the moment. I like that. So this is on the 5-minute time frame. So within the next 33 minutes, I'm going to go down to the lower time frame. When the next candlestick opens up, my strategy usually performs well during the 5 p.m. candlestick East African time. As you can see, it's UTC +3. So whichever part of the world you're going to watch this stream from, convert it to your local time, but look at it at 5 p.m. in the evening, UTC +3. If I have it at New York, what time is it going to be and why? And why it is +80 if I'm not wrong. It's Pacific Standard Time. So it's UTC -4. So at 10 a.m., I like the way things are going currently at the moment. So the strategy usually works well 10 a.m. New York timing. Take into consideration daylight savings time. Always take into considerations, because this strategy, the moment you fail to look into daylight savings time, you're out of the game. So let me go back to my local time. Okay, so this is going to be the position. Now this is the point whereby you find something to do. Find something to do. I like the way things are going currently at the moment. Should I enter a sell position, a small sell position currently? Just a small one, but no, I'm going to wait. I'm going to wait here. Wait, sit on your hands. Wait. But this is a very good entry. But this, okay, so the 30-minute candlestick is closing. This 30-minute candlestick is closing. Now, basically, this strategy works in this way. Yeah? You're asking yourself, you're looking at the H4 time frame. Yes, we are looking at the 30-minute, but you're picturing the H4 time frame. If the H4 time frame opens, forms a wick to the upper side, starts rejecting this opening price, closes below, you're asking yourself, what are the chances before the 4 hours elapses, prices will go from a low, then finally a closing price. So this is what you want to look at. So this is the opportunity here. This is the opportunity that you want to participate in, this here. So that's what I'm going to look at. I usually trade only 1 4-hour candlestick a day. Sometimes it changes. It can change to, let's say, New York session. It changes sometimes to London. Sometimes there was a time whereby it was happening during Asian session. So it's never constant, in the sense that it's never constant, whereby if you look at it during New York, it has to happen during New York. No. camera is not cameraing. Perfect. So I'm in a position now. I've entered the position. We've entered the position currently at the moment at 31.91. Stop loss is at 32.04. Take profit is going to be just these lows. 31.21. These are risk to reward ratio of 1:7. So I'm using a 0.03 just to get started. But I'm going to wait for the next opportunity. I'm going to wait for the next 1 hour candlestick sun. This is going to be the higher probability setup. But looking at it currently at the moment, this is nice. This is really nice. I'm going to have TP1 just at the 50% region at 31.60. 31.60 is okay for me. 31.60 is good for me. So once again, let me do this. Let me take a screenshot. And also take a screenshot here also. So this is how I found myself profitable in the financial markets. Whenever I execute positions, I take a lot of screenshots so that I understand what needs to be done better. It really gives me an opportunity to study myself. So this is a risky trade. This is a counter trend, but looking at it here. So reason of entry, dollar index, volatility index. News has come out negative. We did see which is normal. News usually tends to be the correcting factor that grabs liquidity for a move, for the trend to continue its direction. So as I wait for that, this is the point whereby we get ourselves engaged in some chase games. We get involved with some chase. If you have any inquiry about the stream, kindly talk to me. Talk to me. Okay. We have someone from Egypt, I do believe Yemen. That was a mistake. I have to sacrifice my queen, man. So it's okay. Mm, 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 mm. This was checkmate. Yeah, I can win this. checkmate. Aye, that was checkmate. Oh my lord, that was checkmate. Checkmate. This is checkmate. Ah, that was checkmate. No, it wasn't. Hold on. It was good. I blundered, but I recovered. Where's this? Indonesia. How's Indonesia? I've ever noticed it's like the first trades you usually take. It's not. Start thinning the hard here. Blunder. Shit. Why did you do that? That was stupid. Is my time moving fast or slow? There, these games started nicely. So we have 10 minutes for this candle close. Let me change these. I need a 5-minute game. Spaniard. Okay. It's a 5-minute game, man. So I have an advantage. I can weaken him. I can weaken him the way I want. Haina shida. Tulia kule. Sina ki. Nilikuwa nimekuja. Yeah, bye. No. Kidogo tu. Ouch. So that was a good game. It's not finding any game. Indonesia again. So the next 1 hour started, eh? Let's finish this game. So by the time this game finish, I've seen this opening. That was not going to work for me, Mama. Oh, Baba. It's not going to be that easy. Oh, that was a mistake. Hey, that was a mistake. And he didn't see it. He did not see it. Now he has seen it. But it's too late. I see what he's trying to do with the king and the bishop here, but this guy is very persuasive with the bishops. Let's dispose of this guy. I don't like that guy. I don't like the bishop. I don't like the bishop. Yeah. So let's sacrifice. Let's sacrifice. Yeah. Yes. Now think of something else. Hey, Lagaiba. Hey, my road. He was sondering me with the bishops. He was not giving me any peace. Let me get this free pawn. Second thoughts, it's not a free pawn. Ouch. Fell for that. In this world. The thing is, he doesn't have any bishops, huh? Oh, and passe. I want to get rid of this guy here. He got rid of me. But I've opened up the, okay. Okay, that was a mistake. That was a slip. That was a very expensive slip. Very costly one. Could have advanced. What are you doing, Baba? Can't see this. Okay, let's manage this trade. Okay, let's go down to the 5-minute time frame. I like this. So the ideology, the whole ideology was so my stop loss is at 32.04. Okay. This 5-minute candle is about to close. Huh? Let's see. If I do reject this region, it gives me an opportunity. Now, this is a higher probability setup for me, provided this 5-minute candle doesn't stop me up on the first trade. But I'm looking to enter another position, maybe a 0. Stop loss, stop loss, stop loss. Let's see how it's going to close. So it's closing below that structure. Okay, interesting. So the next 5-minute candlestick might stop me out, but I like the way it's opening. Okay, I'm about to be stopped out. Yeah, stopped out. So I'm stopped out on that particular position. Let's see. Let's see. I'm really looking at selling opportunities on XAUSD. I don't know ways to get a clearer sight of what I'm looking at. Okay. Stopped out on that, eh? But that was good risk management. So let's wait for the 15-minute candle to close. Let's wait for the 15-minute to close. We have already seen signs of rejections around this region. This is just a manipulation. Stop loss being hit, me being one of them. It's okay. But let's see. Let's see. So this is the week. So this one has been fulfilled. Huh? Where are you? So the 1 hour candlestick. Okay, the previous 1 hour candlestick did close below the region. The previous 1 hour candlestick closed below this high. Okay. So the next 1 hour candlestick opened with a wick to the upper side. Now, within the first 5 minutes, it has already passed. Okay. But I'm still looking for selling opportunities to 31.22. Why? Okay. So prices just stopped me out and then started reversing. It's okay. So looking at the 15-minute, huh? I want to look at the 15. I want to focus on the 15-minute candlestick. I do believe this is going to be the entry now. So giving my trade a second chance on this, I'm going to give my position a second chance. Let's see how it's going to close. It just stopped me out and then started reversing. Okay, this is the next 15-minute candle. So a re-entry. Let me hold this here. So 32.0203. Okay, so this is the next position I'm in. So let me delete this one. Let me omit this one. Instead this one. So this is the current position. Very tight stop loss. If it does break below above this region, I don't want to look for further selling opportunities. I had a first initial position here, stopped out. Second position, given my trade a second chance with a much tighter stop loss. So let's see how it's going to go. But I'm really confident about this. So if you are supposed to see the reversal, it has to come technically right now. Looking at it on the H4 timeframe, the H4 timeframe is still lingering above that region. But yeah, I want to see a retracement, a short-term retracement. This is how usually the markets work, whereby you see a retracement back into the range of the day. So this is the range I'm looking at currently at the moment. So I'm still going to pay attention to the 50% region, which is going to be at 3160. I do believe that's going to be around 400 pips or so, around 400 pips or so from the region. And we're going to see how that's going to go for us. But that's going to be it. So can we continue more with chess? I do believe we should. Okay, this is interesting. I really like this position. I've never felt better of a sniper entry than this. Okay, so we do have less than 40 minutes for this candlestick to close. Let's see. I do believe we can wait for the 40 minutes. If it doesn't close below that, then it's okay. We call it a day. We call it a trading day. I don't believe there's any other news released today. How long has this trend been? So I'm about to be stopped out. I think I'm going to call it a day. I believe I'm going to call it a day. Prices are holding really well above the 32.05. On the weekly perspective, yeah, we do have a lot of inefficiencies around the top regions. As you can see, I don't believe this candlestick is going to close this way. Like, I don't believe it's going to close this way. The train has already started leaving the station. So I think I'll have a realistic target profit at 3160 for tomorrow. I'll still want to look at selling opportunities. So less than 10 pips from my stop loss. Trading is boring, man. It's really boring. But someone once told me if it's boring, then it means you're on the path to profitability. So let's wait and say stop. Okay, so I do believe this candlestick is going to stop us out. 30-minute candlestick is closing above that region. So selling opportunities are no longer valid. Trading is very emotional. Okay. The 50% region was the 50% region. 3160. Will you be waiting to grab them? Okay, so the 30-minute candle is about to close. I think I'm going to close the stream of that. So this is the position. So the first one got stopped out. Re-entered the position, tighter stop loss using the same lot size. And let's see how it's going to be. So I've adjusted my take profit. I've adjusted my take profit to be reasonable at 3160. It's still a risk to reward ratio of 1:9. That's quite decent. That's quite decent in the financial markets. Take care of yourself. Stay safe from whichever place of the world you're going to watch and hear me from. My name is Elkington Ian. May God protect you. May your enemies respect you, and may death neglect you and your family. I'm looking through. Okay. So whatever happens, happens, huh? It reaches a point whereby you have to make peace with the markets. Okay. Where's the tab for streaming? Where are you, darling? Once again, take care of yourselves. Huh?